Welcome to today's webinar, sponsored by OnApproach. My name is Pete Kears and I'll be your moderator today. I'm Senior Engagement Manager for OnApproach. OnApproach is a QSO focused on data and analytics. Since launching our M360 Enterprise Data Warehouse solution, we've made it our goal to provide credit unions with the means to transform their data into action that benefits members. One of our fundamental strategies is to partner with excellent companies that leverage data to serve their credit union clients. This webinar is a part of a series dedicated to showcasing best-of-breed products and services of OnApproach partners. Our topic today is the CECL journey, meeting the CECL challenge. Our presenter today is Peter Cherpack, partner and executive vice president at Ardmore Advisors. Ardmore is a strategic partner of Argus Information Systems, a global provider of bank compliance software platforms, assisting in the design and implementation of CECL software for smaller institutions. Peter is a division manager of the Credit Technology Group that focuses on credit data management and risk control. He has been with Ardmore since 2002 and specializes in assisting financial institutions in credit data management best practices, CECL, and ALLL calculations, stress testing, and concentration reporting solution. Peter is a nationally recognized thought leader in best practices for concentration management, stress testing, and CECL's impact on community financial institutions. Before joining Ardmore, he worked for nearly 20 years at PNC Financial as vice president in the Network Services Division, supporting bank-wide projects involving technology support services. There will be a question and answer at the end of the presentation. Please feel free to ask questions via the chat or the questions function during the session, and I will read these during the Q&A. So with that, Peter, I'll turn the presentation over to you.
Well, thanks, Pete, and thanks to OnApproach for hosting this event for us and giving us the opportunity to share really what's going on currently with the CECL implementation and the new ALLL rules. It's nice to be with OnApproach. You know, we had the pleasure of being at the conference, the Analytics and Financial Innovation Conference there in Minneapolis earlier this year, and look forward to being there. So hopefully some of you on the phone met us there at the conference. So let's talk a little bit about this CECL, but before we do that, just to introduce the two groups that I'm representing. Ardmore Banking Advisors is a company that supports small community financial institutions with credit data management, loan review, and credit policy consulting. We've been around for more than 25 years, helping smaller institutions meet or exceed regulatory expectations in these areas. Argus Information Systems, we're strategic partners with this group. They're the ones who developed software platforms for bank compliance, and they're headquartered in White Plains, New York, and have developed, with Ardmore's help, this community financial institution package solution for CECL. And that's what we're going to talk about what's going on in the industry as well. And so this is me. I got a nice introduction there from Pete. Makes me realize how old I am, so I think I'm just going to skip that. The three groups here that we're talking about are OnApproach, who you know, obviously, because you're here attending this. OnApproach is going to host the data set, collecting the information that's needed, and transfer that to Argus. Argus has the secure hosted platform running on the IBM cloud, and that's where the software, and if you're using the product set, that's where you'll be accessing the platform. And Ardmore, the company that I work for, and I'm a partner there at Ardmore, we're the ones who are the credit experts who really help you set up the program, making sure that the way you do things today, if you're going to use it for your current model, or help you with setting up for CECL. We're also your first line of defense for questions, problems, any kind of need you might have about either testing, trying different methodologies, setup and control of the product set. So the three of us together, I think, is a pretty good best-of-breed solution with both data management skill sets at OnApproach. Argus is a really global development group and Ardmore with the real boots on the ground experience working with community financial institutions. Okay, so that's the end of that promotional stuff. Let's talk about what's going on and how this is going to affect your institution. So I'm not going to do a great deal of detail on what CECL is. I think that at this point, most institutions know what it is, but CECL does stand for Current Expected Credit Loss, and it's supposed to be a way to replace the current ALLL reserve process that is typically a backward-looking process, where you look at what has happened in the history of losses in your institution's portfolios, and looks instead forward at what could happen and tries to basically create a life of loan loss estimate that you book at the time you book your credits. And it also incorporates in it a projection, which is considered a reasonable, supportable projection of what you think is going to happen in the economy and how that's going to affect your losses. So this is the first time that the regulators or the auditors have come up with an idea of trying to, as it were, bake in a projection of losses to be countercyclical, so that the idea being that if you think times are going to get worse, you're going to reserve more in anticipation of that. If you think things are going to get better, you might reserve less. And according to the rule, you can do that. And it's very, very flexible as to how you do that. But you do have to justify, defend, and explain what you're doing and why. So essentially, that's what the CECL rule is, a new way to do reserves that's forward-looking, that includes a life of loan estimate at the time you book the credit, including an update to current economic conditions, plus a projection of a reasonable supportable period. Now, this is a very, very open standard, and there's lots of ways that it can be interpreted. Smaller, less complex institutions have the opportunity to reflect a less complex approach, but there are some basic things that you have to be concerned about. And that's what we're really going to spend the next maybe half an hour talking about. But just as an idea from an overall view, the picture on the left you can see is shows sort of a mountain. That's representing a loss curve. A loss curve is basically how many losses are realized over the life of the institution of the credit. So obviously, when you book a loan, you don't expect a lot of losses right away. Typically goes up to a bell curve, and then after it gets through most of the term, the losses tail off again. So under the current reserving process, you typically do a 4-quarter projection of actual estimated loss, and that will be represented by this dark square here. Under CECL, you have to reserve the entire loss curve. So when this is particularly important is when we have the bubble years of moving from the current incurred loss model to the CECL rule. And for most of you on the phone, that's probably going to be 2021. There is no gradual buildup. You have to go be doing the incurred loss model in 2020, and in 2021, you go right to CECL. And if your portfolio is mostly new and you have a lot of new credits, you might be over here on the loss curve, which means you're going to be reserving for all of this. If you have a very seasoned portfolio and you're over here on the loss curve, you'll be reserving just for this. So this can affect the lending strategy of the institution, both consumer and commercial, and can also affect the amount of capital that may have to be shifted around in order to handle the new reserves. The one-time hit to capital is something that an institution wants to know about at least a year ahead of time, so that you can plan for that. So you really want to be running CECL runs well more than a year ahead of time so that you can see what the impact is. There is confusion in the industry about what this really means. We've gotten conflicting opinions between auditors and regulators, and between regulators and other regulators. To this day, we have regulators saying that this is not a big event for a small institution, and auditors saying that it's a sea change. So it really is something that the institution is going to have to take on. Companies like Ardmore can help, but in the end, the decision making is going to be on the part of the institution. and the justification. So let's talk about some of the things you have to be concerned about. It's more than just the calculation. I think that's part of the problem in the industry, is that everyone's just sort of focused on the quant stuff, and there's really a lot of other things to consider. Give you an example. So according to the standard, the institution is supposed to create their best estimate of what the actual expected losses are. So in effect, you take the value and then you discount it for what you think the actual losses are going to be. The first problem you have is defining what life of loan is, because, for example, it's rarely is life of loan the actual term from origination to maturity, because there's prepayments. Also, if you have a revolving credit, such as or something like a credit card, life of loan is not really that clear. If it's a revolving credit, it might be something you re-underwrite, in which case that's life of loan. If it's a credit card, you have the concern of how do you know when the loan is actually, or the credit card payment is actually due as a life of loan. So that's still, particularly the credit card side, is still being thrashed out by the FASB board. But institutionals, it'll be up to you to define what life of loan is for your different asset pools. You may have to modify your asset pools. For example, under the rules of CECL, your asset pools are supposed to be risk-based. Most smaller institutions today are using regulatory codes or classes, asset classes, not risk-based classes. So obviously, if you have to change your pooling structure, then your loan loss history would have to be readjusted as well. And that's the first place where you run into issues with things like data. Because if, for example, you're forced to break your collective pools into, let's say, more risk-based pools, like using regulatory risk rating groups like PASS, Substandard, Watch, you're going to have to go back in time, find your losses, and then reorganize them using the same criteria, and that data might be long gone. So obviously, other concerns are, what is a reasonable supportable economic projection? How do you do that? We can talk about that in a little more detail. You also have to do a tremendous amount of documentation, justification, defense, and rationale explanation in the narratives of why you think this is the life of loan and why you think this is really the best estimate of loss. You also have to validate any calculations. So if you use a vendor like us, for example, our platform, we'll expose to you the calculations because they're not that complicated, but they are pretty, a lot of data crunching. You'll have to validate that the expected results match what comes out. Disclosures are also very extensive, and I'll show you some of those. The whole idea of creating this reasonable supportable loss projection is a bit tricky as well, because you have to use very credible sources, and that's usually the term that the auditors are using now for explaining what is a reasonable supportable projection. The sources, credible sources, might be things that are publicly available, like published by the Fed on their economic projections, or other agencies. It could also be you can purchase projections from places like Moody's and S&P and Case-Shiller and others who can project what's going to happen. But these sources have to be noted, and they have to be considered credible by the auditors and the regulators. The accuracy of how it turns out is not really something they're going to be testing. So, for example, if you say that you believe the interest rates are going to go up 300 basis points this year, and you factor that into your projections and they don't go up, you're not going to get dinged for that, theoretically. However, I'm sure that your investors, shareholders who don't get as much dividend because you added that into your reserve might maybe be a little unhappy if it doesn't actually happen. But you have to figure out how long you're going to project for as well. We know, obviously some has to do with the term of the instrument, but there's no recipe for exactly how long you can do these projections for. We've heard 18 months, we've heard a year minimum, but it's pretty wide open. Part of the idea is that you might want to try to align your projections with your more typical other projections like economic cycles for interest rate management or your strategic planning for capital. If you're, since most credit unions are locally focused, using national projections of economic behavior is probably not as effective as local. So you may have to do a little work to try to find credible sources that look at more local footprint information to factor into your projections. And again, if you're doing other projections, such as if you're underwriting commercial loans and you're projecting the impact of potential interest rate change, you're doing stress testing or something else, you want all of the projections to be in alignment. You don't want to have one going one way and one the other. So things like this, the best practices around creating this reasonable supportable loss projection are still evolving. But data is the key, and that's why we're very pleased to be working with OnApproach, because OnApproach is going to help us with the data issue. You need data for a number of reasons. One of the things that always bothers me about the vendor presentations is people saying, well, you need lots of data, but they don't tell you why. So I'm going to tell you why, at least why I think you do. One reason is because, again, I mentioned if you have to change your loss history to make them more risk-based, then you need data in order to go back and reorganize your loss information. If you're going to try to understand the projections and how economic behavior impacts your portfolio, for example, let's say if interest rates go up, how does the average credit score change, or DTI or delinquency? You need to have historical information about that to do so. So when was the last time interest rates went up? What happened to my HELOCs, for example, when that happened? Well, if you don't have that historical information, you're unable to slice and dice the history. You're going to have a difficulty justifying your projections with empirical data, which is part of the objective of the whole process. So fortunately, credit unions have at least 3 years before they have to comply with CECL. So 3 years of data would be pretty good. So if you're not collecting data at a level of detail that will support things like looking at how slices of the portfolio perform when economic factors move, you should be doing that now. Also, the disclosures are very, there's a lot of data required to do the detailed disclosures that are being added thanks to CECL. I'll show you some examples. So you need data for that. And again, you're using it to really support any kind of change you would make. So for example, if you add certain basis points to your portfolio pools under CECL, you're going to have to justify it with data to show what loans were deteriorating, what conditions changed, what behavior happened that made you believe that you wanted to change your estimates, all with data. There's a theory that you should even have market cycle information, because the last time we had a recession, as we know, was 2010 and 9. If you don't have that history, you really can't model that. So the other thing that goes with all this, of course, are controls, in that this data has to be controlled because it's being reported to the street. So you have to have governance around a direct lineage from the source data to the data you're using for CECL. And again, having an OnApproach database format or data store is a great way to do that, because single data sets that are accurate can be much easier to establish controls and show auditors a direct lineage from the source to CECL. What kind of data do you need? Well, these are all kind of standard, and some of these are more commercial oriented. You might have, instead of LTV, NOI, DSCR, you might have DTI, delinquency, credit score kind of things for the consumer side. Historical information, obviously prepayments are important. I mentioned that. Charge-off and recoveries. We think a monthly feed will probably be sufficient, in transactional data probably not needed, because you can derive changes in deterioration from this. A lot of good news is data mapping process is being put in place so that your data coming through the OnApproach data structure will be mapped directly to the Argus data mart. Of course, that doesn't mean that you're putting the data in. It only means that the file format will be correct. So it's really up to the institution to look at what data do I have, what data am I missing, and how am I going to remediate that. So we do credit data assessments for small institutions, so we can do it in a day and a half, where we come in and we ask a bunch of questions about what data do you keep, where is it? Is it in origination systems? Is it in your core system, your accounting system? Is it accessible? And what are you missing that you might need? And that's really something you can do yourself, or you can use people like us to help you figure out what data you should be capturing and what it means. External data can include any of these sorts of metrics, local, regional. You could use the DFAST federal projections, although they haven't proven to be very accurate, and they tend to be national or international in scope. I don't know how much value, the value of the yen is to a credit union in Iowa, but so really we think local data probably is more useful. Although some of these factors are actually built-in unemployment rates, for example, into our solutions, so you can choose them right from there. And when talking about data, I should be remiss not to mention that if you don't have a lot of loss information that you can use to model for CECL, OnApproach is putting in what they call a data lake, or a large data mart with anonymized data. So if you choose to subscribe to that, in theory, you might be able to use some peer data from that as well to supplement what you have internally. I mentioned before the narrative report is important. Definitely is important. This is the way the story of the numbers is told. So just performing the calculation, figuring out what your life of loan loss is, figuring out what your pools are going to be, doing the projections is one thing, but you have to explain all of that in your narrative report. You need to explain your assumptions, your rationale, why you did what you did. And these might include doing the calculation, but it also is how different areas of the institution have contributed to the process, what controls are in place. You also documenting what you didn't do. So for example, if you don't use vintage, which is one of the approved methodologies for estimating loan loss, you may have to explain why you don't think that's the best method for your institution. Maybe the best place to start is to think about the narrative report and work your way backwards. That's some of the things that the people are thinking about. As I mentioned, disclosures are more involved. There are some very detailed disclosures that look very much like vintage calculations. And let me just show you an example of one. Here's one right out of the back of the ASU. You can see that what they're asking you to do is what they call disaggregate your assets. So this would be residential mortgage. You might have, consumer. You might have real estate. Any number of different asset classes. These subcategorizations are up to you. And then within that, they break them into risk grade, and they are asking for 5 years of detail. The 5 years is a requirement for larger institutions. For smaller, less complex institutions, you can start with 3 years and build your way up to 5. So that would mean you would start with 2018 data, working your way up through 2021. So to us, I mean, if you're going to do all of this, you basically are doing almost a vintage analysis anyway. There's also a new disclosure requirement on days past due, delinquency, accrual, non-accrual, again, using that disaggregation process. Another issue to think about is the whole idea about reverting to historical loss rates. So if I didn't mention this, let me restate. The idea here under CECL is first you take your historical loss rates, then you bring them to current, then you add a reasonable supportable projection. When that reasonable supportable period is over, you're supposed to revert to your loss history. So this reversion is not completely clear as to how you want to do that. And so, for example, so let's say you have loss rates and you've decided your reasonable supportable forecast period is 18 months, but this is actually a 3-year term. So you're going to have remaining term to maturity, and you're supposed to revert to historical loss rates, which may be out of sync with your projections. The theory of this was that this would stabilize somewhat of the loss rates, that by having a reversion to actual, but it doesn't explain exactly how you do that. Do you smooth this curve so that instead of going basically falling off the cliff, do you go and bring it down gradually? Do you do averages? How do you want to do that? Again, there are best practices still evolving on this. We've been told the regulators are not giving any guidance on how to do any of these things. I believe the quote I heard them say at the IACPA conference was, "We're not going to build the guardrails before the road is constructed." And left a lot of us shaking our heads because they said, "But get started now." They didn't say get started doing what. But anyways, there's another thing that we have to think about. Other implementation challenges: if you were a public business entity, an SEC filer, you'd be going live in 2020. It's only 2 years away. Privately held and non-filers 2021. One of the things that a lesson learned from the large banks who had to implement IFRS 9, which is an international standard similar to CECL, large banks that have foreign subsidiaries have to do that. They found out that if they spent too much time trying to figure out the answers to all these questions that we just talked about, and ran out of time to run parallel for any significant period of time, meaning that they had very little time to adjust their estimates. So I really do want to get started soon, building up the data, putting your plan in place so that you have time to run parallel with your current process. Also, that known need for capital impact is something you really want to know ahead of time for capital planning purposes. And one of the concerns we have is that there are about 6 ways you can do the estimate of loss: vintage, loss rate, migrations, discounted cash flow, probability of default. You are supposed to decide the best one for each asset pool, which would mean that you'd have to try different ones and see which ones work best for your institution based on your complexity, your type of lending, and just really how volatile this estimate ends up being based on things like term and the like. So it's important also to start socializing the concepts of CECL within your institution. Now, a lot of you guys are maybe smaller institutions and people wear many hats. That makes it easier to socialize ideas when they're the same person, but there are definite distinct areas like, IT, which may be required to set up data feeds, and operations groups who may have to now add more data in to systems in order to be able to recall it later. Obviously, credit, lending, risk, audit, all those guys. So one of the big questions we often get from the smaller institutions is, can I do this on a spreadsheet? I mean, I do it on a spreadsheet now. Why would I want to do it any other way? Good point. And certainly, particularly the FDIC has been pretty vocal about saying if you're a small institution, you can do this on a spreadsheet. The problem isn't really the calculation. It's getting the data and putting it in an auditable, repeatable process. If you're doing this on a spreadsheet, you're going to have to try all the different pooling structures by hand. You're going to have to try all the different methodologies by hand. You're going to have to run parallel, which means you're basically doing it twice. And you really have to document everything, put in controls. It can certainly be done manually, but it's going to be a lot heavier lifting for the institution, particularly smaller ones who don't have resources available to go out and try all these things and learn all these things and build all the different methodologies. So, as far as your complexity, if you're small and less complex by any definition, even that has to be justified and rationale explained. Depending on which methodology you use, you may have different historical data inputs. There's different impact on, for example, what you do with the economic indicators. Your loss accumulation period can be different. So, for example, a vintage analysis, which if we have time after the questions, I can do a quick demo of one of these for you. A vintage analysis is based on the origination quarter of the credit. So you have aggregate of loans by asset type, by quarter, and then you track those for life of loan. Those have inherent economic indicators built in because you're looking at a point in time. So the market was and the economy was where it was. Whereas if you're tracking pools that are more similar to what you do today, you have to add more economic adjustments and justifications because they originate in all different times. So how should you start? Well, we think that data is the start, and I'm sure OnApproach would agree. Typically, in a smaller institution, there's minimal controls and governance over the origination process and the data. There's a focus on getting things on the books and getting statements out to the customers, and less worrying about things like DTI and credit score and original versus current and other things like descriptions of the type of credit and collateral and the like. So there's usually a lot of scrubbing that's needed in the current state. We argue very passionately that doing an assessment of what you have versus what you need for CECL and some of these other regulatory requirements is something you should be doing today so that you can begin to formalize the way you do things. Remember, that includes documenting your standards and your processes, putting in controls on how the data moves from here to there. You know, having a lender or a branch person, you know, someone at the credit union actually make decisions about what buckets loans are going to go into, maybe by accident because they're the ones who are assigning DTI ranges or loan types. That could be tricky because they may or may not really understand the impact of those decisions. So something really you have to think about: who owns those decision-making processes that slots these credits into different pools that are risk-based. So you really want to take a look at that, and as well as the data itself that you're retaining. Your goal would be to end up in a long-term goal state of having one version of the truth about all of your loans and consumer, commercial, residential. You'd want to have the data mart or a place like in OnApproach offers where all the data is centralized, organized, accessible, controlled in a repeatable manner. And then use that data as many ways as you can. Because once you've got it, you're going through the effort to clean it up and get it out there, then you absolutely want to use it as much as you can. So use it for risk modeling like stress testing, use it for reports, board reports, executive reporting, regulatory reporting, as well as your ALLL. So, where are you today? Excuse me, we're hearing a lot about institutions who haven't started doing anything about CECL. And really in 2018, there's a few things that you should be aware of and working on. We talked about CECL awareness, and let's not forget the fact that it's not just the finance group who has to be contributing to this process. It's lending, it's operations, it's IT, it's audit, and there really needs to be an interdisciplinary group who sits down and talks about this and figures out who's going to do what and what their roles are. Should really be doing that now. And let's not forget the executives have to sign off on the calculation. They need to understand what it means. I already talked about credit data assessment, building up your database of information so that you can do these disclosures and calculations in 3 years. And then through the end of 2018, looking at possibly automating your current ALLL so you can run parallel more easily, looking at different models that are available, seeing if you want to try to build or buy. If you're buying, possibly even implementing so that in 2019, you can do the parallel runs that you need and fine-tune your calculations and processes in preparation for going live in 2021 and understanding the capital impact of that conversion. So that's sort of the path that most institutions are looking at now. You're right here, or just about right here, where you are in this scale of activity. It's going to vary by institution. But if you're just starting now, I think it's a good idea to dig in. The examiners have already said that they're going to start asking all institutions, regardless of type and size, about their CECL roadmap and plan. So you really want to not be there with no answer. You want to have some ideas. And it's early for the smallest institutions, so now's the time to start putting that in place so you're ahead of that curve, not being asked to defend why you don't have a plan. So how can we help you prepare? I'll wrap up with this, and then if we have questions, I can try to answer those questions, and if we don't, then I'll do a demo of CECL Calculation for you. So again, Ardmore, we're the data people and the credit people. Argus is the software people. We can help you with the CECL data requirements. We can do that credit data assessment. We can also help you with the calculations. So once you get through the inputs, it's really doing the calcs and the different ones and trying to run parallel, see what the impact is. And ongoing support. This is an evolving thing. Next couple of years, things are going to evolve and change, and best practices will become codified as the institutions, early adopters start doing that, as auditors start becoming clearer on expectations. Our job is to go to the conferences, to meet with these people, the regulators and the auditors, and be able to then, for our clients, keep them up to date on what the issues are and what the best practices are. Partnering with us gives you that kind of a resource. We do the credit data assessment. We've done this for a number of institutions already. I think we've done about a dozen. And like I said, we can do this as a standalone thing if you just want help looking at what data you have and assessing what your remediation steps should be, or we can bake this into a CECL implementation as well. The Argus software, as you can see this graphic, trying to kind of give you an idea that if your credit union, you have a number of data sources. Let's say they're an origination system or origination process where you're simply using Word and Excel. You also have your core. All that data will go into the OnApproach data store, which will then be transmitted to the Argus secure data mart, the data warehouse. It runs on IBM software. We have all the SOC 1s, 2s, and 3s, and all those things that you need for your vendor management people. And then out of that will come various applications that you can access, which includes the CECL calculation, the current ALLL, reporting, and stress testing. This is the idea of leveraging this data as much as possible so that it brings the most value to your institution and your shareholders and your community. And again, the output is reports and dashboards and calculations, which goes back to you. Again, the center of this thing is this data hub that really feeds from the OnApproach structure. The CECL solution it's a workflow-based solution. It's very simple to use. That's one of the things that Ardmore really had to do with working with Argus, was to make this something that we felt met or exceeded regulatory needs, but wasn't so complicated and over-engineered that you're buying something that's hard to use or had a lot of features and things that you didn't need. So we think that the solution here is complicated enough to handle a wide, diverse portfolio, or simple enough to handle more community-based functionalities, but still addresses giving you the ability to run multiple scenarios with different calculations, methodologies. It's a place where you can archive documents and justification information. It's a place that'll generate those disclosures for you. Also, you can use the current methodology that you have, automate that, which brings benefit as well. So one of the things I hope you got out of this presentation was that we're pretty bullish on the fact that this process, the CECL process, while it seems pretty arduous, it's something that can actually bring a lot of benefit to your institution. Because sometimes institutions particularly in the operational areas, when you get to putting loans in, really don't go back and look at their workflow processes. They don't really look at how data is managed because you didn't really need to so much in the past, and there's a pretty strong community institution view that if it's not broken, don't fix it. So it's quite possible that if there's data out there that you have that you're not using, that could be useful for decision-making purposes and strategy. You could look at performance in different areas that you've never looked at before because you never actually tried to collect that level of information. You can also not only do that, but expand your reporting so that you can monitor concentrations, regional, local, based on counterparties, based on types of lending and consumer groups. So there's a great opportunity to improve information flow. Something as simple as helping everyone in the institution understand what the numbers mean. We certainly worked in our data assessments with small institutions where one person talked about outstanding amount and another person was talking about book amount, and nobody was really sure which was which. Or one person was looking at the DTI at origination, another was looking at DTI current, but they weren't sure what it was based on. So here's an opportunity for a small institution to go in and really start to understand their data, start to build governance around it that you didn't have before, which is something the auditors really like, and it's very helpful to an institution. And let's not forget that idea of projections and getting your projections aligned so that projections in underwriting, projections in strategy, and liquidity management are in alignment. Very often, institutions have silos and people don't know what the other group has and don't have a clear understanding. So it's great that with this process, if you follow it, you can start to realize a lot of these benefits along the way. So that's my update for you as far as what's going on with CECL today. What are some of the things you need to think about? And at this point, I think I want to hand it back to Pete at OnApproach and see if we've got some questions. And then if we have any remaining time, I'll be happy to do a quick demo of a CECL calculation for you. Pete?
Well, great. Thank you, Peter. I have a few questions here. If a credit union uses the FICO score in underwriting, will they be required to pull credit to measure score migration for CECL, or is that optional?
Well, that's a good question. I would say that based on the language in the rule, FICO could well be your credit indicator, credit risk indicator that you are basing your pooling on, you're basing performance. And it's also a great indicator of changing behavior in an economic cycle. So, but it's expensive necessarily to rescore all the time. So could it be used? Yes, I think it would be very justifiable, and I think that it would be understandable for both auditors and regulators that that's a very credible source of information about risk performance. But I think there's also an understanding that you wouldn't be pulling every quarter FICO scores for everything in your portfolio. So you may look at just the larger exposures that way. You may take semi-annual or annual scores. It's going to vary based on what you think is reasonable and supportable. But I think FICO is a good credit risk management tool set to use.
Okay. Next question. If your pool aggregation does not include, say, DSC, is it still expected that you will capture that information?
Well, expected is probably not the right term because of the fact that the standard is so loose that there are no clear expectations yet as to what the critical data elements are. I don't think that it's expected. I think, however, the more similar kinds of borrower data information you can collect, the easier it is for you to justify your projections and your rates. So DSC is something that you can collect, and you can factor that into your assessment of potential risk. I would do it. If you can only do it on certain types of credits, then you can only do it that way. So I'm sorry if it sounds like a consultant's answer, but a lot of this is still not codified. The best practices still not come out. But if you can, the more borrower risk-related characteristic data you can collect, I would do it.
All right. One other question for smaller institutions. Peter, what are the chances that this will be delayed because it is so much for a smaller institution, or maybe a carve out at some point? Any chances of that?
I know this is a question I get a lot, and I can tell you that the CECL rule is not part of Dodd-Frank. It's not on the president's radar right now as far as something to address, unfortunately, for the smallest institutions. You know, the concerns they have are generally for larger banks, like moving the systemically important bank from 50 billion to 250. Those are the kinds of things that they're worried about. The FASB rule, which CECL is coming from the Financial Accounting Standards Board, is not really a regulation. It's a accounting standard. And it's an accounting standard that they took them many years to develop. And it's going to be enforced by the regulatory bodies as GAAP, GAAP practices. So, and the auditors particularly like it because it forces institutions to look forward. I think it's very unlikely that it's going to get delayed any further. It's already have been delayed for several years. I think that the answer a regulator would give you is, well, it's going to be really simplified, because they use the term scalable for smaller institutions. So they're going to say, we're not going to be really hard on you the first time you do it. Follow the concepts, the spirit, the tenets of best estimate, using these concepts that are in the CECL ASU, and don't worry about being super accurate in the beginning, but you're still going to have to follow it, and all institutions are going to have to follow it to some degree.
Okay. I'll just ask the audience, any other questions? You can post those now. I have another question. Might call report level be appropriate for first several years until populations and histories with DSC are in the data?
I think so. I think it is, but and again, it also depends on your portfolio mix. If you happen to be doing commercial lending, there may be a requirement, if you saw that disclosure that I showed, that you slice those out by risk grade or some sort of risk attribute. But probably in the beginning, you can get away with that, the call code pools, and maybe address some of the other issues with qualitative factors. You're still going to be able to do qualitative factors under CECL. And in fact, you can even do the projections as a qualitative factor, but it makes it really hard to justify unless you expose all of the rationale behind that qualitative factor, which kind of means your qualitative factors have become quantitative, but that's a whole nother discussion.
Okay. Well, with that, I think what we'll do is we'll, Peter, if you have time for a brief demo, we appreciate everyone's attendance for this up to this point. Feel free to hang around for a few minutes to watch the demo here. I'll also mention, for those of you who might be leaving now, we will have an email follow-up sent to field any further questions, and a link to pertinent information, including a recording of this demo. And Peter, will your slides be available, or should we just will they just be on the recording then?
Well, they can reach out to me for the slides. I can send them a PDF. That's not a problem. And obviously, we have the Argus Cloud website has a lot of information and resources as well. So I can include that in an email back to anyone who's interested.
Okay.
All right, well, I'll just do a quick show. I know that some people are interested in saying, well, what does a CECL calculation look like? And so for those who are interested, I'm more than happy to share. I'm just going to pop into the Argus Cloud infrastructure here. You can see that we use a dashboard sort of approach because we think that's most intuitive. So here would be a dashboard that an analyst or whoever's running the ALLL might be using. You can see you would have broken out your collective pools, your individual impaired credits if you have them in PDRs. Let's just take a look at a pool, for example, just so you can get an idea of how it works. Here would be a list of all the credits in the pool, and you could modify these. You can look at the data underlying them. You can move things in and out of pools as need be. The fun part comes in the calculation. So in the calculation, let me take a pool and show you how that works. What we do is, first thing that happens is we need the loss rates, the net loss rates. So we're assuming that you'll have charge-offs that'll be by quarter. In this case, because we're doing a vintage loss rate, we're looking at origination quarters for life of loan. And you can see we've broken this particular loan pool into up to 3 years, 3 to 5, and greater than 5 years, because this particular asset class goes that far. So we would want to have all the losses broken out that way. And you can see that they get converted into loss rates based on the amount of assets in the pool. Now, since this is a very scenario-based process, we have the ability to do multiple scenarios. So if I wanted to, here I could also add loss rates, but they get flagged from an audit perspective. But we know not all the loss rates are necessarily in the core or in your source system. So sometimes you have to go put them in. You just have to be able to document that you did it. When you create a new scenario, you have to indicate for each sub-pool, for example, what is your reasonable supportable period for projections, because that can vary, so we'll put 4 in there. What economic indicators do you want to use? We do have groups of economic indicators that you can use to factor into your projections. You can select and group those. Economic outlook, whether you think it's stable, adverse, you can make your own severity levels. And then when you have exhausted your reasonable supportable period, what methodology do you going to use for your reverting to the loss history? And if I hit start, what it will do is basically take this information and create what is in effect a workbook. So we tried to make it as Excel looking as possible because most institutions are used to Excel. And you can see that the front of this gives you a recap of all the decisions you have to make, including your look back periods, your loss accumulation periods, and all the decisions you made, including economic indicators that you wanted to include. We still have our charge-offs here, our loss rates here. Here are the economic forecasts. You can add your own, obviously, or adjust them. And then here's your 4-quarter projection based on using regression. And then, here's the magic that you want, which is you want to be able to create the loss rates. So for each quarter, here are the actuals. You can see the beige numbers are the actual loss rates. The 4-quarter projections are in gray here, using the economic indicators that we plugged in, plus any changes that you might have. And then the green is reverting back to your loss history. And then you get the rates here shown on the right. You would then be able to go in and do your qualitative changes. And these all get set up in the software by Ardmore based on the way you guys want to do it. So we have the 9 regulatory categories, but sub-drivers that can be customized. And we can add and take them out or change them as you need. You can have your own severity effects. You can set up your own ranges of how many basis points that is impacted. Obviously, you can put remarks in here, save them. You can always save and attach documents. And then we want to calculate and save, and then take a look at the summary. So that's how simple it can be if you have the data. And you can see here in the summary, There's the community adjustment. Here's the factors. Doing this for the 3 subpools for one asset class, you know, it's certainly not highly complex, but it's a lot of information. If you're using vintage, you need to have life of loan information across the whole history of the asset class. You know, for some consumer shorter term credits, vintage might be a good solution because it bakes in those economic indicators. But for any longer term loans, like a commercial mortgage or something like that, it's probably tough to track that much time. I did mention that we do have reporting. I can show you some of these reports. You know, we're running out of time, so just to give you an idea, I mentioned before the disclosures. So here's an example of one of the disclosures generated automatically for you based on having the data in the data mart. And you can see how that looks there. We hope that this has been informative to you, and that if you're interested in a more detailed demonstration, something that you're planning on buying or making a decision on in early 2018, please give us a shot. We'd love an opportunity to talk to you about it and to show you what we have. So thank you, and thank you to OnApproach for hosting this.
Sure. And, Peter, one question did come up from a result of your demo. Does the calculation use a shared data set in OnApproach, or not just your own portfolio? Can you comment briefly on the data that a credit union would have to supply? Sure.
You're not allowed to use collected peer data for the entire calculation. That idea was surfaced early on with the regulators because it would have been very easy to do it that way. And the answer was no. You have to start with your own data. However, so when we're doing this calculation, this is going to be based on the data you've input into OnApproach, and it's going to be your institution's data. That said, you will be able to supplement for missing information. Like, for example, if you've had no losses at all in certain asset categories, how do you justify what the loss amount should be? You can use peer data for that, and if you can use regulatory summary data that's available. And we understand that OnApproach is planning on building out an anonymized data lake or a receptacle where you will be able to share all OnApproach data if you opt in. I don't think that we have a clear vision on how that works yet, but I think that would be a very valuable tool set for OnApproach users.
Great, thank you. With that, I think we'll wrap up today. We did mention that there'll be an email that goes out as a follow-up, and it'll have information on how to ask any follow-up questions and access the information from the webinar. I'd like to thank Peter Cherpack. Thank you very much for your expertise and your information. I'd also like to thank my colleague Mark Ports for handling all the behind-the-scenes work for the webinar. Again, thank you all and for your participation in today's presentation. Goodbye.
Bye.